last week when we were doing our monthly webinar, I was talking about the current consensus forecast for economic growth for the United States. And you can see that here in the slide with the black bars indicating actual quarterly GDP growth and the three red bars indicating the current consensus forecast for the current quarter, the second quarter, the third quarter, and the fourth quarter. And you can see that most economists then continue to believe that we'll see increasing momentum, in other words, increasing rate of GDP growth quarter over quarter for the next 3 quarters through the end of the current year, 2012. Now, the logical question, I think, is, well, wait a second, isn't our economy largely consumer spending dependent? And if that's the case, then why are economists relatively optimistic about growing consumer spending, where everybody knows consumers are tapped out, everybody knows job formation is sluggish, and so forth? So I just wanted to spend a few minutes specifically on this topic because it's the crux of the economic forecast, or the basis for the current relatively optimistic economic forecast, which again is what you see in this chart. This is the current consensus from the 50 economists surveyed every month by the Wall Street Journal. And interestingly, in this chart also, I thought it worth pointing out that the black line here is the actual GDP growth, and the red line, the set of red lines, the two parallel red lines, are the Federal Reserve's latest so-called central tendency GDP forecast looking out through 2015. And again, here you see that the Fed's economists, that staff, economic staff, also believes that we'll see accelerating economic growth all the way out through 2014. So again, I think the logical question is, wait a minute, why would economists be relatively optimistic about an increase in the rate of growth with the headwinds that are so much in the headlines? Okay, well, to start with, to analyze this question, I thought it worth pointing out how our economy, GDP, is indeed a function of consumer spending. And so this is the breakdown of U.S. GDP by category. And you can see that personal consumption expenditures represent 69% of GDP. And by the way, I've extracted, I've not included net exports in this calculation just for the sake of simplicity. But you can see that then consumer spending on services is the single largest category. Non-durable goods and durable goods then are the other pieces. And corporate investment, corporate capital expenditures are 14% of the GDP, and government consumption is 18%. So again, the lion's share of U.S. economic pie is personal spending. Now, in the second line on this chart, what you're looking at is personal spending. The 70% of GDP that you so often hear referred to is the second line in this chart, taken right out of the government accounts. The BEA is the source of this data. And so what I wanted to illustrate with this chart is the clear recovery that we've seen in consumer spending that's actually started in mid-2008. In other words, you can see the recession, the big downshift in both personal income, the top line, and personal spending. But believe it or not, we are more than 3 years into a pretty typical looking reversion, I should say a reversion to a pretty typical looking upward trending consumer spending line. So the question is, the $64 question then, in analyzing consumer spending and the outlook for consumer spending, is what's driving it, and is that sustainable? What's driving it, of course, is the top line, disposable personal income. If Americans have had rising income, they've had rising spending, almost in fixed proportion, which is the story told in this chart. Fixed proportion meaning the second line on the page follows the top line, tick for tick. The gap has widened since the most recent recession and global financial crisis, and by the way, the difference between the top line and the second line on the page income and spending is savings, the bottom line in the chart. And you can see how savings surged in the height of the financial crisis and recession, and saving has been once again trending lower, such that the current savings rate is back to 3.8% most recently, as Americans have regained confidence in the outlook for growing income, as well as having substantially repaired their household balance sheets, which I'm also going to get to here in a minute because it's an important aspect to the personal spending, the consumer spending story. But again, the main takeaway from this chart is that personal spending, 70% of GDP, is the second line on this chart. We are already more than 3 years into recovery, and you can see that spending follows income. So again, the key question is, will the top line, can we reasonably assume that the top line will continue higher, more or less at the rate that we've been witnessing post-recession? And the answer to that question, I believe, is yes. It very likely will. Now, what you're looking at here is a breakdown of the top line on the preceding chart. This is a deconstruction of the constituent components of disposable personal income. And the red line in this chart is employee compensation, also known as monthly paychecks. Monthly paychecks in this chart are on the left axis, and all other contributors to household income are on the right axis, such as interest and dividend income, proprietor's income, government transfer payments, and rental income. Those four categories are all on the right-hand axis in this chart. It's significant that I point that out because, as you'll notice, the two scales are very different, which is to say that monthly paychecks, the red line, dwarf all other contributors to disposable personal income. That's an important consideration because, among other things, you've heard people say, and what you can see so plainly in this chart, for example, is that interest and dividend income has pretty much flatlined here, and that's very true, particularly with interest rates on money market funds, for example, being close to zero. There has been virtually no growth in this interest and dividend source of consumer income. And government transfer payments have actually been trending a little bit lower, most recently flattening out post-recession, as unemployment insurance claims, which surged here, have been trending lower. But again, the important takeaway in this chart is that monthly paychecks, on the other hand, the lion's share of disposable personal income, have reverted to this, I think, to an extraordinary degree in many people's minds, have reverted to this long-term trend rate of growth, similar to the rate of growth that we saw prior to the recession. Now, as I said earlier, the $64 question is this trend likely sustainable? So then you ask yourself, what's behind this? What's driving monthly paychecks and growth in monthly paychecks? And the answer to that is rising employment. In other words, the 115,000 net new jobs created in the month of April, for example, and 120,000 created in the month of March. Before that, actually, that was revised higher to 168,000, I think. Okay, rising employment, rising hours worked, and, believe it or not, small wage gains have been consistent and have been contributing to the growth in employee compensation. Now, the question is, what do economists think about the prospects for these increases all continuing? And the answer to that is most economists, as they analyze the drivers behind rising employee compensation, the red line, continue to believe that we'll see a continuation in rising employment, rising hours worked, and small wage gains, such that we can reasonably expect this red trend to continue, and that will then logically continue to drive the top line in this chart higher. And therefore, my own view, my own conclusion from all of this analysis is that personal spending, the second line in this chart, very likely will continue along this upward trending path with something like a 3 or 4% slope. And that is, of course, the key driver behind the GDP, and that's why the consensus forecast among economists is what it is. I think most economists then are rightfully optimistic in that set of forecasts that we talked about. What about household net worth? And the reason I wanted to focus on this for a second is that almost without exception, every month that the Case-Shiller home price index is published, or the federal government's similar national home price index is published, and we see flat to downward trending national home prices, the concern is raised, by the way, that wasn't the case this most recent month. It looks like home prices perhaps have bottomed finally. But the point being made so often in the media is that, well, if Americans are not seeing an increase in the value of their homes, aren't they apt to curtail their spending? In other words, to what degree is consumer spending actually linked to the value of consumers' homes? And the answer to that is, I think, a lot less than is often suggested by the media. One reason for that, and this relates directly to the so-called wealth effect or negative wealth effect. In other words, to the extent Americans are upside down in their home and versus home mortgages, to the extent Americans feel poorer because the value of their homes have declined, doesn't that suggest that Americans will pull in their spending? The answer to that is no. I don't think that's the case at all, which is, again, what you can see in this chart. Even though household net worth contracted in this period, what you can see here so clearly is spending is linked to income, not to the value of Americans' homes. But what I wanted to illustrate in this chart is something that I think is counterintuitive based on a lot of the commentary I hear on television and elsewhere, which is to say that, as a matter of fact, Americans' equity in their homes is a lot smaller portion of Americans' total household net worth than one might ordinarily assume. And specifically, it's just this 10% piece of total household net worth that you see here most recently recorded. And again, I wanted to point this out because so much of the conversation often has to do with the value of Americans' homes and therefore household net equity in real estate, and actually it's a fairly small piece of the total household net worth pie, and I think a lot less of an influence on spending behavior because of that. And finally, I wanted to comment on household debt because the new normal crowd, that is to say principally Mohammed El-Arian and Bill Gross at PIMCO, I think, and I'm not meaning to point fingers here, I'm just giving you the facts. I think those two in particular raised this question, this notion of new normal being the likelihood that consumer spending won't recover anytime soon following the recession because Americans are wallowing under a mountain of household debt, and therefore how can you expect consumer spending to recover anytime soon as long as that's the case. And this is the statistic that was usually cited in that connection with the new normal hypothesis. And you can see here how this mountain of household debt went from roughly a little less than $4 trillion in 1990 over the 30 years illustrated here to $14 trillion. And usually that measure of household debt or leverage was presented in this fashion, in this format, a ratio of household debt to disposable personal income. And again, you can see that that number went from 0.85 to almost 1.4 here at the peak, and having declined subsequently to about 1.2. But nonetheless, the ratio has significantly increased over the last number of decades, suggesting Americans have incurred lots more debt than was the case 3 decades ago. And again, this statistic was often cited as a reason to believe that we wouldn't see and will not see a return to, let's call it, normal levels of consumer spending anytime soon. And my point in showing this data is to suggest that that is a very misleading statistic. The reason is you're comparing a stock of debt to a flow of income. From an accounting standpoint, you're comparing a balance sheet item to an income statement item, and you're getting a fairly meaningless result, a meaningless statistic. What really is important, on the other hand, is a comparison of monthly household income to monthly household expenses, not the stock of debt, but what it costs to service that stock of debt, plus all other recurring monthly expenses. So the Federal Reserve, as a matter of fact, does the calculation in the proper way. And every quarter, the Fed gives us their so-called Consumers Financial Obligations Ratio. And here, as I said, the Fed is doing the calculation properly and trying to assess relative health or lack of health in household finances, household balance sheets. Specifically, the Fed's calculating what percent of monthly after-tax income for the average American household has to be set aside to cover all those fixed recurring monthly expenses, starting with a mortgage, but then going to a car payment, a rental payment on a tenant-occupied property, homeowners insurance, property tax payments, and utility payments and telephone bills, all those fixed recurring monthly expenses. What percent of average monthly after-tax income has to be set aside to cover all those things? And the answer is 15.9%. Wow. That's a radically different, that's a substantially different conclusion than one reaches from the preceding comparison of household debt to disposable personal income. If you compare monthly income versus what it costs to make all those monthly payments, including servicing that debt, one concludes that, as a matter of fact, our Americans are in better shape that, or as in, are in equal, are in a financial condition equal to what they've seen in the best of times, going back all the way in this chart to 1980. It also suggests that Americans have already substantially repaired their balance sheets such that they're feeling lots more confident than they were just 2 years ago or 3 years ago, and which is what we saw in the declining savings rate, and of course the continuation or reversion to a normal rate of growth in spending. So that what we see here is the proof is right here in the pudding. The proof is right here in this remarkable recovery in retail sales. This is the monthly retail sales statistic, and as you can see, retail sales went out to new highs from the previous expansion peak here, went out to new highs beginning in April of 2011. So the point of this chart is to suggest that we are already 1 year into record high territory on retail sales. So the point I wanted to make here is that I think to some degree the impression persists out there among average savers and investors that Americans are struggling to, still struggling to get their feet under them, still struggling under a mountain of household debt such that consumer spending hasn't and will not anytime in the near future return to so-called normal. And what I'm suggesting here is that is a very mistaken impression.